Fed holds rate steady at 5.25 to 5.50%. Markets await next move amid inflation concerns. For immediate release, Washington, D.C., January 29, 2025. The Federal Open Market Committee, FOMC, concluded its two-day policy meeting today, announcing its decision to maintain the target range for the federal funds rate at 5.25 to 5.50%. This decision signals a pause in the rate adjustment cycle, marking the longest period of rate stability since early 2022. The committee's vote was unanimous. The FOMC's statement emphasized the need for a balanced approach, acknowledging both the progress in curbing inflation and the lingering uncertainties surrounding the economic outlook. Recent data, particularly on consumer spending and housing starts, suggests some moderation in price pressures. However, core inflation, especially in services, remains stubbornly above the Fed's 2% target. Key economic indicators: the FOMC reiterated its commitment to achieving price stability and indicated that future policy decisions will remain data-dependent, focusing on key indicators such as 1. Job creation numbers. 2. Wage growth. 3. GDP. 4. Housing prices. The Fed anticipates that inflation will remain persistent for some time and does not expect a transitory decline. The committee remains strongly committed to its price stability goal. The statement read, "While inflation has shown signs of easing, it remains elevated. The committee will carefully monitor incoming data and assess the cumulative effects of monetary policy tightening, including its quantitative tightening program, to determine the extent of future policy adjustments." The Fed confirmed that it will continue its balance sheet reduction program, as previously announced. Balancing inflation and growth. The Fed's decision reflects a delicate balancing act, as policymakers navigate the complexities of managing inflation, while supporting sustainable economic growth. The statement acknowledged the continued resilience of the labor market, but also noted potential headwinds from 1. Geopolitical tensions, including ongoing conflicts, create supply chain bottlenecks. 2. Fiscal policy uncertainties, particularly regarding government spending levels and upcoming debt ceiling negotiations. Looking ahead, March projections. The FOMC's economic projections will be updated and released in March, providing further insights into the committee's assessment of the economic outlook and anticipated interest rate trajectory. These projections will include updated forecasts for 1. Inflation. 2. Unemployment. 3. GDP growth. The previous summary of economic projections, SEP, hinted at possible rate cuts in Q4 2025. Analysts will now reassess whether the Fed adjusts its outlook based on new data. Market reactions. Following the announcement, equity markets reacted cautiously. 1. The S&P 500 experienced a slight decline of 0.3%. 2. The Nasdaq saw modest gains, led by tech stocks, such as Apple and Microsoft, which rose by approximately 1.2%. 3. The Dow Jones Industrial Average traded sideways, with a minor increase of 0.1%. In the bond market, yields on the 10-year Treasury edged slightly higher, reflecting investor sentiment about future interest rates. Rate-sensitive sectors like banking, technology, and real estate exhibited mixed performance. Some analysts believe the Fed's cautious stance signals a prolonged tightening cycle, said John Doe, chief economist at XYZ Financial Services. "We don't expect rate cuts before Q4 2025. The US dollar strengthened slightly against major currencies following the announcement." Conclusion. Key takeaways as investors digest this latest decision. They focus on upcoming inflation reports and economic data releases. Any stronger than expected figures could reignite concerns about prolonged high interest rates. Key takeaways. 1. The Fed kept rates at 5.25%, 5.50%, emphasizing data dependency. 2. Inflation remains above 2%, particularly in services. 3. Investors are now focused on March projections and inflation data. Stay updated on Fed policy shifts. Subscribe for real-time insights. About the Federal Reserve. The Federal Reserve System is the central bank of the United States. Established by Congress in 1913, it aims to provide a safer, more flexible, and more stable monetary and financial system. The Federal Reserve conducts monetary policy, promotes financial system stability, and supervises financial institutions to ensure soundness and consumer protection.